Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Ideanomics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a microcap company, 36 million market cap. They're trading at $3 a share and they have 12 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doesn't look so good. It's negative every single year, mainly because they don't bring in much revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that gets worse each year from negative 100 million to negative 319 million. Revenue is a sales for the company, and that peaked in 2021 at 114 million, and it's been cut in half since then, down to 60 million. Their numbers don't paint a pretty picture. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 147 million. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $42 million. We divide that by 12 million shares. And we get a calculated stock price of $3.51. They're trading at $2.97, so they're trading at a 15% discount. It's a buy according to the model. I'm assuming they're going to have positive free cash flow by 2026, because I can't really assume they would have negative free cash flow forever, because then the value of the stock will be negative, which is not possible. I personally don't think they could ever have positive free cash flow, so I wouldn't buy the stock. So you could think of the model as one scenario that may happen. Just like if you buy a lottery ticket, there's one scenario you win the lotto, but it's nearly impossible. You're probably not going to win the lotto. Like this stock, there's one scenario where the company does well, but there's probably a 99% chance they're going to file bankruptcy any day now. There are 27 companies in the same industry as IDEX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only $3 million. The most is Deere, $2.3 billion. They have a good debt to equity ratio. For every dollar of equity, they have 30 cents of debt. Companies that don't generate positive free cash flow usually don't take on debt because they don't have money to pay back the debt. If you see a company with negative free cash flow that's taking on a lot of debt, then run, because they're definitely going to go bankrupt if they don't generate positive free cash flow in the next few years. The average free cash flow in the industry is 270 million. They're negative. They have a really small market cap, only 36 million. The average is 8.1 billion. Deere is the largest. They do have the most attractive price to book. But when a company has a really attractive price to book or price of sales, like extremely attractive, below 0.5 or even below 0.1, that's usually right before they file bankruptcy. They're 0.2. Price to book is market cap over equity or stock price over book value per share. We can't look at their PE or price to free cash flow since they're negative. Price to sales of 0.6. That means their revenue is higher than their market cap, and their 5-year annual revenue growth rate is negative 31%. The best is Shift Group, 20%. They just released their second quarter earnings, and here are some of the highlights. Solectrac debuted their new tractor, the E25H, also launching a tractor rental program. Solectrac manufactures electric tractors. Energica, a company they own, and Plenitude partner together to provide new innovative solutions for electric mobility. Ideanomics finalizes divestments of Timios and Justly. So their revenue for the second quarter was 8.2 million, 13% lower than the second quarter of 2022. For the first half of 2023, revenue of 13.8 million, that's down 19%. Since their stock price was below $1, they did a reverse stock split. That means they multiplied their stock price by 125 to bring it up above $1 so they do not get delisted. When a stock trades below $1 a share, the company's stock may get delisted and put onto the OTC. There's a lot less liquidity on the OTC than the NASDAQ or New York Stock Exchange. So if you own 125 shares before the stock split, you now own 1 share. If you put $10,000 into this company 10 years ago, right off the bat, you would have been at $35,000. But if you're still holding, you'd be at $155. those reverse stock splits kill you. So your investment will be down 98%. Let's take a look at their second quarter press release. About the company, they're looking to accelerate the commercial adoption of electric vehicles by bringing together vehicles and charging technology with design, implementation, and financial services. Let's look at their income statement. Revenue for the quarter, $8.2 million, down from $9.4 million. Their revenue is up for the first half of the year. It's $13.8 million for the first half of 2023 compared to $11.6 million for the first half of 2022. All the expenses directly related to generating the $8.2 million are $7.5 million. So they do have positive gross profit of $700,000. Last year they had a gross loss of $500,000, but their operating expenses are much higher than their gross profit. Marketing expenses alone are $24 million. Then you have R&D, $3.5 million. Impairments and depreciation, about $9 million. Operating expenses of $36 million. Operating loss of $35 million, compared to a loss of $37 million last year. So their net loss for the quarter is $37 million, and their shares outstanding went up a ton. Last year was 4 million. Now it's over 10 million. They're diluting their shareholders like crazy. Let's look at their balance sheet. Current assets of $61 million. Current liabilities of $119 million. That's a big red flag because they're bringing in negative free cash flow each year. And their current ratio is below 1. So that means they don't have enough money to get through the next 12 months. They're going to need to either add more shares or add debt. If a company has a current ratio below 1 and they're bringing in lots of free cash flow, then it's not that big of a deal. I think Coca-Cola has a current ratio below 1, but they bring in so much free cash flow and they can easily take on debt if they needed it. This company would have a difficult time taking on debt. They only have $3 million of cash. That's down from $3.8 million at the end of 2022. $23 million of inventory. Their biggest asset is intangibles, $150 million. This could be customer relationships, computer software, licenses, trademarks. So total assets $300 million, up from $242 million. In their liability section, they have $58 million of accounts payable. That's up a lot from the end of 2022. It's about double. This means they owe people for buying on credit. It's similar to debt. Instead of receiving cash, you're receiving a product. So their total liabilities are $200 million, up a lot from $96 million. So their balance sheet looks pretty weak. Let's look at their equity section. They added $1.1 billion from selling their business. They lost $1 billion from running their business. So only $78 million of equity. It looks like the company may go bankrupt next year. Let's look at them on Simply Wall Street, trading at $3 a share, 36 million market cap, down 31% in the past week, down 96% in the past year. Ouch. Let's learn a little more about the company. They develop zero-emission mobility solutions for the off-highway and on-highway commercial vehicle markets in Asia, Europe, and the US. Their mobility business unit focuses on the commercial adoption of EVs by commercial fleet operators. This business unit provides solutions for procurement, financing, charging, and energy management for fleet operators of commercial EVs and zero-emission mobility solutions, such as the provision of commercial electric vans, trucks, buses, electric tractors, and two-wheel transportation, supporting by the provision of energy services and infrastructure for the EV market, comprising charging systems, energy storage, and energy generation, including hydrogen and solar, and associated data and management application. They also offer high-power inductive charging solutions for medium and heavy-duty EVs. They manufacture and distribute electric power tractors. They manufacture and sell electric and hybrid electric propulsion kits, as well as electric motorcycles. They sell EV bikes, scooters, and batteries under the Tree Electric brand. They design, manufacture, market electric commercial vehicles, as well as perform retrofits to convert diesel-powered electric specialty vehicles. Their capital business unit provides financing services, which focuses on the enhancement of efficiency, transparency, and profitability for the financial services industry. This unit offers solutions for real estate transactions, including title and escrow, residential and commercial title insurance, and closing and settlement services, as well as specialized offerings for the mortgage industry. Also a platform focused on private equity and debt. They were incorporated in 2004, headquartered in New York City. Let's look at the risks. High volatile share price over the past 3 months. Earnings have declined 46% per year over the last 5 years. Heavy dilution the past year, and does not have a meaningful market cap, only 36 million. If you adjust for stock splits, the stock peaked at $28,000. Of course, it was never this high. That's because they multiplied all their previous stock prices by 125. That's how you adjust for the split. You can't really tell from this chart how much the stock went down, but you could tell it went down pretty much 100%. If you look at it in the past 5 years, in 2021 it had a peak of 678. Now it's down to a few dollars. Simply Wall Street does not value this stock, and there's no analyst valuations either. They were pretty much debt-free from 2013 to 2018. Then they added a few million of debt. It got up to 22 million in 2019. It looks like they added a bunch of equity to pay down the debt. Then they took on a lot more debt, 81 million, paid that down within a year, added about 64 million. They paid most of it down. It's currently at 17 million. But if we add their equity, they always have more equity than debt. Their debt to equity ratio is currently 19%. So their equity is 90 million. 19% of 90 million is 17 million. And this green line is their cash. It looks like they issued a lot of equity at this point because they had 400 million of cash. But they're almost totally tapped out. They have hardly any cash remaining. The CEO's salary is $670,000, total compensation $2.4 million. So at least somebody at the company is making money. It's sure not the investors. His tenure as CEO is 4.5 years. In the past year, there's been one insider buy by the CEO. He paid $31 per share. Ouch. 96% of the company is held by the general public, 3.7% by institutions, and 0.6% by insiders. The biggest shareholder is Berg & Berg, 3%. Shane McMahon, the son of Vince McMahon, he owns 0.36% of the company. Invesco, 0.19%. The CEO, 0.13%. Bank of America, 0.03%. Citigroup has some stock. On the bottom here, Bank of Montreal, the asset management arm, they own 520 shares, a whopping $1,500. The holding company Ideanomics doesn't have really any employees, maybe a few. Their subsidiaries, the companies they own, have employees. It went from 108 in 2012. Their subsidiaries have 565 employees. And the stock trades in 3 places: the NASDAQ, London Stock Exchange, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.